Welcome to Weekend Investing Daily Bites. We are shooting episode 331. Should we invest in IT stocks? Is the dilemma. Most people are struggling with this idea that stocks have fallen in IT. Should we buy them? Should we not buy them? We'll take a look at some charts today and give our thoughts to this. But first, the message to all our subscribers that the Wild program is on. You are enabled for the Wild program as your renewals will come. If you have spent a year with a strategy, you'll get a Wild 20 code already enabled. 2 years or more, you'll get Wild 25. 3 years or more, you'll get Wild 30. If you have clicked auto renew on your renewals, then you will not be able to use loyalty discount. So you need to unclick the auto renewal and use the Wild code applicable when you're doing a renewal manually. So please be aware of this and use these account discounts judiciously. Also to subscribe to other weekend investing strategies. So a lot of people I'm seeing that when they are renewing their current subscription, they are using the Wild code for the renewal, but they are not. They most of them don't know that the same offer can also be used for any other weekend investing strategy for 30 days. So please use that. Nifty is, as I mentioned yesterday, in that band of 17,800 to 18,100, and today it contracted and almost made a inside bar. You can see that it was just restricted to uh, you know 100 points or so, and the big breakout will happen either below 17,800 or above 18,130, 150. So this is something that is being watched. Maybe the CPI in US markets tomorrow evening may cause this bigger move to come around. But it is always seen that when markets become quiet and it's choppy in the very short time frame, a bigger move is about to unleash. So be aware of this and be ready for a larger move. Metal stocks up 0.8% despite the choppiness. PSU banks recovered a bit at 0.7%. Private banks also up 0.4%. IT stocks up 0.3%. FMCG and consumption lost the most at minus 1.1% each. Energy stocks also losing 0.8%. So, sort of a nothing day where Nifty managed to close at minus 0.1%, and even other broader indices were no major gainers. Small caps were in the green, but marginally so. CNX 500, CNX 200 also marginally in the red. Mid and small caps index also 0.2% down. So nothing really uh, earth shattering happening today. And similarly, on all weekend investing strategies, half a percent to plus half a percent, minus half to plus half a percent on all strategies. So, kind of a dull, nothing sort of a day. In terms of the heat map for Nifty 50 stocks, you can see Hindalco and Sun Pharma did well today, plus 2.8% and plus 1.6%. Tata Motors also up 1.2%. Bigger losers were Bharti Airtel, minus 3.5%. Cipla, Dr. Reddy's, Cipla's is minus 2.8%. TV's Lab minus 2.5%. Reliance minus 1.2%. Coal India, ONGC, Hindustan Levers, Nestle, Tata Consumers. These were the stocks which were leading the index down. Is it a good time to invest in IT? So let's take a step back and see where we are and where we've come from. Uh, First, the first and foremost that IT stocks are primarily driven by the US markets. I mean, we cannot deny this fact that IT, CNX IT stocks, uh, a large portion of their business comes from the US markets. So the US technology stocks lead the trends that get mirrored in the Indian IT stocks. This chart is showing you a more than 30-year trend of the S&P 500, not even the Nasdaq, the S&P 500 and the Nifty. So I wanted to start from a larger bird's eye view of where we are. So a lot of people have this view or conviction, or maybe hearsay conviction, that US markets does very well versus Indian market, and Indian markets we are not doing so well. So this is a 30-year chart of US versus India, and I have normalized Indian Nifty returns in the orange line by dividing it with the USD INR. So both they are both in USD terms. You can see both of them over 30 years have done the same. I I would like you to write in the comments if you are surprised. The first time I saw this, I was surprised. So both have gone up about 1,000% each over the last 30 years. Yes, the journey has been different. In the decade of 1990 to 2000, uh, S&P 500 did very well. Nifty was flattish. Then in the decade of 2000 to 2008, emerging market boom, Nifty did very well. US markets actually went down in that decade. In the next decade, both did well, and they have been in sync since 2013-14. So what people say in India is that this is a Modi wave that has been happening in India, but I mean it's a Modi wave happening in the US also then. So they have been pretty much in sync since 2013-14. But prior to that, you can see that there was huge divergence, and the hedging and the getting the portfolio of US and Indian stocks would have been ideal in those decades. Right now, not so much because we are pretty much in line and in sync. So this was the sort of background. Now let me superimpose on this same chart the chart of CNX IT in dollar terms. Now this light aqua line is CNX IT. The orange line is Nifty in dollar terms, and the blue line is in S&P 500 in dollar terms. You can see where IT stocks have taken us. IT stocks are up 5,000%. Uh, and this chart was only available since 1998, so I couldn't go back to 93. But nevertheless, S&P is up 266% in the last 24 years. Nifty is up in dollar terms 705%. So we are comparing like to like, dollar to dollar. And IT stocks are up 5,000%. So this is the beauty of IT stocks in India, that we are able to get the growth from the US market, but able to juxtapose that growth in our Indian context and go bonkers in terms of returns. Now, this is another. Please write in the comments if you are surprised. Uh, this is the Nifty CNX IT chart since 96, 97, and you can see that from a very low base, it went up to about 8,000 in the dot com boom. Then it returned to about 1,500. Then it stayed sort of sideways for a long period. And only 13 years later did it break out from this dot com high. And it has had a huge run since then. So even at the bottom of the COVID crisis, IT index was somewhere 12,000 something at the bottom of the COVID crisis, and it went to about 38,000. So it went almost three and a half or 3.2%, 3.2x in this run up. So going from 12,000 to about 38,000 is a huge run in 2 years. So there is no, you know, surprise that if they have fallen, maybe about 30% from there. After a run up of 3.2x, you can always expect a 30, 40%, 50% correction. I mean, you take any strong move in the history of any bubble, any asset class, this will happen. So It is natural that this is happening, but it is also a fact that this is a tremendously powerful chart over decades, and it may continue to do so. Maybe it will chop around for 1 year, 1 or 2 years, and then it will go to 60,000. It is very much possible. Another thing to note is this is the RSI over the monthly time frame. This is a monthly chart. And you can see that the RSI has come back to about 50 levels, which is somewhat, the resting heartbeat of the RSI in the Nifty IT terms. Of course, it does go to crisis levels also, but it has not gone to those crisis levels. So maybe some more crisis at 40, 35, 30 may come. It is always possible. But as of now, it seems to be normalizing, and this seems to be a good place, for a resting for some period. Another chart on Nifty IT, you can see this was the run up that I was talking about on the Nifty IT, and after having corrected, it has started to sort of chop around in the same 26,000, 31,000, 26,000, 31,000 range. And this region is a big support here. We had chopped around for almost 6 months in 2021 also, so this will give tremendous support here. So this region probably is where it will stay around till the next move starts up. So I'm not hoping that this will go below this, but this is just to give you context. In momentum investing, we are not even looking at IT stocks right now, but because everybody is so geared up for discretionary investing, so in daily bites we will also cater to the interests of non-momentum players. Another chart of Nifty IT last 25 years or so. One very nice observation here is that Nifty IT has never fallen more than 2 years in sync in consecutive years. So we've had at worst 2 bad years in Nifty IT, and then a third good year, or at least the fourth one. You had 2 bad years here, and then it started up. 2 bad years started up. 2 bad years started up. 2 bad years started up. We are now in the second bad year of CNXIT. We may come down a little bit, maybe it'll come down to 24,000, 26,000. Maybe. I'm just guessing here. And then we may start our upward journey again. But just look at the size of these two candles. After these two candles, I mean, it is fair that we get some drawdown. So this was all about Nifty IT. All I can say is that with momentum strategies, you don't have to play this guessing game. As and when the you know very well that Tata Elxsi and KPIT and several of these IT stocks, Wipro at one point, uh, then Emphasis. Uh, Several of these stocks have come into our fold from time to time when they were high in momentum, and we've made good money on many of them. So we will wait for the sector to start to perform, start to run, and then we will enter. We are in no rush. A lot of people want to catch falling knives. I mean, good luck to them, but we definitely don't want to get our hands dirty with blood. We'll wait for the stocks to tell us that please come and buy us, and we will buy them then. Switching gears, some very interesting insights were shared by Ritesh Jain. I follow him on Twitter. This is from uh, the stlouisfed.org. Uh, what is this chart? This is the blue line is the Fed funds rate, and the green line is the Wilshire 5,000 stock market cap. Wilshire 5,000 is like 5,000 stocks market cap calculated on this line. So, what is the interesting observation here? That whenever the interest rate cycle peaks out and the Fed pivots to lower interest rates, the markets make a bottom much after that. So, in 1990s, you can see Fed pivoted here, and a year later, the market bottomed. Uh, in 2000, the Fed pivoted here, the market bottomed somewhere here. A year and a half later, the Fed pivoted here in 2008, market bottomed here, uh, and there was a pivot here, in 2019. There was a market bottom with the COVID, and we are now looking for another Fed pivot. Whether it comes in 3 months, 1 month, 4 months, 6 months, nobody knows. But it will have to come because interest rates cannot keep going up uh, forever, because it hurts the US economy the most. And once that happens, and if this phenomena plays out, then the bottom is still far away in terms of global markets. Now, we are obviously bucking that trend. We are few percentage away from all time highs. So we may stay flattish or slightly weakish till then. And then once the world starts to, when this trough trough is made, whenever this trough is made, then of course we will go bonkers, I think. I mean, we are all set to go up right now, but because the world is in a situation where we cannot go, full steam ahead, so we are waiting for others to stabilize so that we can go forward. That's the kind of thought process that I have. And this is, again, from a GDP perspective, on a real GDP basis. The red line is the GDP line, and the blue line is the effective funds rate. And here also you can see that once the Fed pivots, the GDP bottom comes a bit later. So there is a lag effect. Although intuitively you may think that, tomorrow Fed may signal a pivot, and from there on, uh, the economy will go up. So economy will take some more time, and probably stock markets may also take some more time to bottom after that, if this trend continues to play out. So very, very interesting insights. uh, I share this not because of any other reason, because this all none of this impacts weekend investing strategies, momentum investing, because we are not watching these parameters to decide whether to buy or sell. But it's a very, very interesting insights and good knowledge to have when you're in the markets. Another one, my favorite topic is gold, as you probably have figured out by now. Um, so this is the gold chart of the last many days, and you can see that a flag is getting formed here. And my suspicion is that once we do conclusively take out this 1880, 1885 area, you could see a 50 dollar jump uh, on gold prices. This is a very typical flagpole pattern, and let's see how this plays out. I'll update it once it does. So thank you so much for watching the Weekend Investing Daily Bites. It is my pleasure to continue to bring my thoughts together on this. By doing this, I also help myself. So there is a selfish motivation here. I learn a lot while preparing for this. My team prepares the slides and the ideas, and they are also learning along with me. And of course, we are in a environment of offering our products, so that also gets helped. And hopefully you are also getting some information and knowledge out of this. So my earnest request from you is, every day please share this with one individual at least. That karma will come positively to give you benefits over a long period. Thank you. Bye.